Chapter 17, Business Valuations. Now, as always, make sure you read the chapter very carefully. There are several good examples in the chapter. They work you through the numbers, the actual numbers on computing a business valuation. So those are very good. Make sure you follow those very, very closely. In these slides, we're going to look at the basics, so let's get started. First of all, appraisers usually come from either a finance or accounting background. Of course, that makes sense. There are a couple of, really a handful of appraiser certifications you can pick up. Here are just a couple of them. The CVA, Certified Valuation Analyst, that comes from the National Association of Certified Valuation Analysts. And then there is the ABV that comes from the AICPA. And there are a number of others. These are just two as examples. Before you start a business valuation engagement, make sure you have what's called an engagement letter. Here they're calling it an engagement agreement. That's fine. But you need to make sure there are certain things that are very clear between you and the client before you get started. The first point here, you want to clearly set forth the expectations of the business valuator and the client. Okay, what is it that the client wants? What is it that you can produce? Also, in point 2, it reduces the chance for misunderstanding and therefore the risk of malpractice litigation. They might come back on you if something happens, and also claims against the business valuator. So a very well-written engagement letter will really do a lot to clear up any misunderstanding that could possibly happen in the future. Point 3, it increases the likelihood of the valuator being paid, since it establishes a clear obligation on behalf of the client. That's very important. You want to make sure that you do a great job, but you also need to get paid and get paid on time. Continuing with this, you need to, in the letter, identify the client. If a shareholder comes to you and says, I want you to value my 25% ownership in the business, your client is that shareholder. Your client is not the business, not the corporation. So, again, make sure exactly who your client is. Specify the interest. In my example I just gave, you want to place a value on the 25% stock ownership in XYZ Corporation as of a certain date and for a certain purpose. Is the corporation going to buy this person out? Is this person going to sell their stock to someone else? And so forth. And also the intended use of the valuation. That's sort of what I just mentioned. Define the standard of value. We have a slide coming up in a minute that shows you the various standards of value. You want to assign responsibility for the fees and cost. In other words, your client needs to pay you. Your client needs to cover your cost. You need to be clear about the price of the engagement. What's the overall amount you're going to charge the client? Plus, you might add to this other costs that you incur along the way. If you have to get real estate appraised, and you have to hire someone else yourself to get a building or land appraised, then you would pay that person, and your client will need to pay you, reimburse you for those costs. You as an accountant, you're not a real estate, appraiser. You're going to value the business. But if the business includes land, building, equipment, you get other appraisers to come in and place values on those. Obtain a retainer. Always do this. This can be $1,000, $5,000, whatever. You need to get money up front. And then we need to protect against the use and misuse of forecast by clients. What this means, I think we're going to see this again in a minute. What this means is you need to make clear what your valuation is to be used for. So if you're valuing someone's 25% interest in the business, you don't want, let's say, the business itself to get a hold of the valuation. I mean, they'll see the report anyway probably, but you don't want them to use it, for example, to go get a loan at a bank. You need to state clearly what your valuation is to be used for. And you can see a couple other items listed here. There are many purposes for valuing a business. It can be for tax purposes, divorce distributions, liquidations, ESOP plans, and a whole list of other items. There are some general types of valuation. There can be an asset-based approach. This is one you don't use very often, but it could be used. The income approach, this is used more likely than not. You're basing your valuation based on some kind of income amount, cash flow amount, or something similar to that. There's a market approach. This could also be used. And it says here, this type of valuation looks at what the market is paying for a similar business. And you would, use that to compute your valuations. Here are the standards of value. Are you going to compute a fair market value on the business? Is that your intent? Fair market value. Could it be fair value, 100% controlling interest? The third one you see quite often, it's a fair value, but you're valuing a minority interest. And sometimes minority interests have marketable value, sometimes they don't. So look at those 2 points. Points 3 and 4, they both say minority interest, but one is marketable, one is not. It would not be marketable if, for example, the shareholder has, let's say again, 25% ownership in the business, but they cannot sell that freely to anyone else. If they want to sell their shares of stock, they must sell it back to the business, or they must sell it to an existing shareholder. So that interest is not marketable. Then you look at investment value, what an investor would look at to value the business, or an intrinsic value. If you look at the income approach, there are various ones. There could be the capitalization of income method, that's discussed in your book in much more depth. Discounted future income method, discounted future cash flow method, those are similar. You're going to estimate income out into the future, cash flow out into the future, and then discount that back to present value to help you establish the fair market value of the business. There's also a capitalization of excess earnings method. This one is not used very often, so we're not going to talk about it very much. The market approach, here's where you need guidelines. For the public company, you look at similar companies, market value, stock value and so forth. Look at market data, past transactions. If it's a smaller company, maybe you can find out where other businesses similar to the one you're trying to value have sold. That's a transaction. The cost approach, this is not used very often. It could come into play if the agreements for the business, when people were buying into the business, said, if you want out of the business, if you want to sell your share, then it's going to be based on the book value of the business. Usually book value has nothing to do with market value, so this is not used very much. Adjusted book value, again, they're talking about here adjusted net asset value, not used very much, and it does not represent fair market value of the business. What you will need to do before you start the engagement is gather a lot of information. So you will contact the client ahead of time, develop the trust and rapport. You want to have a good, this says brief, but you want to have a good understanding of the business, at least to start here. Determine who in the business will be responsible for gathering information. So if you say, I need certain documents, who is it you're supposed to contact? You explain the valuation process and the timing. It might take you a month or more to complete this. And then on the last one here, determine the methods of corresponding with the client. You want to make sure that if you're going to correspond with the client, is it okay to do it through email? You don't want the client to come back and sue you later saying, you sent me an unsecured email, one of my employees saw it, and now they know I'm thinking about selling the business. So you determine up front, all right, client, how can I correspond with you? You'll need to determine what information is required, what data is required. So does the client have future financial forecast and results? You might want to look at industry-related valuation issues, and then you might want to request information prior to company interviews. You will go interview the management of the company, but you'll need to know the company fairly well before you go to the interviews. Many evaluations start by looking at the past history of the company. You want to see what trends the companies have had. What do they say about the possible future? How good will the future be for this company? and you want to see how well or how poorly a company performs compared to industry peers. So is there something about this company, maybe its location, that it does either better or worse than similar companies in the same industry, given certain economic situations? And you want to see key elements of the company strategy. Are they looking to expand? Do they have plans to expand, and so forth? So very, very important. One of the most important, if not the most important statement, is the income statement. Yes, you'll look at the balance sheet, and I would also look at the cash flow statement if there's one available. But the income statement is going to be very important. This is going to show you the historical performance, the results, how have the results varied over the last 5 or 10 years, and also how to assess management strengths and weaknesses, and how will this impact an investor's perception of the shares as an investment. For example, if the company just wants to sell to new owners completely, then the new owners want to know how has current management and employees, how have they, taken the company forward? What are the good results? What are the bad results? So again, very important information here. Let's take that a little bit further. When you analyze the income statement, you'll look at past trends, growth rates, variability in individual annual results, overall observed results, and this will help you identify appropriate questions to go back and ask management. You'll look at gross profits, just for another quick example. What are the components of goods sold, cost of goods sold? How is cost of goods sold calculated? You will also look at all the operating expenses. You see if they seem reasonable, see how they've changed over the years. Operating profits, are they good and steady? Other income and expenses. So you don't just look at the bottom line, because the bottom line could be influenced by other income and expenses that are not usually there on a year-to-year basis. So your operating profits, your operating income, to me, is more important sometimes than your final net income. And then they also throw in their pre-tax profitability, and I would say final net income as well, which would be after tax. Standards to follow. So when you're preparing a valuation, then this is what you need to consider. You need to be independent, because sometimes a valuation ends up in the courtroom, and you might be there as an expert witness to defend your valuation. You need to be independent. Your fee cannot be contingent on an appraised value. It must be based on your time. You need to be aware of any limiting conditions. For example, maybe you're requesting certain documents, certain information, and you're not able to obtain those. Now, if you don't get what you need for the valuation, you cannot prepare the valuation. You might not get everything you need, and that could be a limiting condition, but you have enough to prepare a valuation. You can look down through the rest of these. It talks about the report content. We'll look at that in just a minute. Data collection and analysis, methodology, and finally, conclusion of value. So you must state a certain value for the business. You don't leave it to guesswork to give paragraph after paragraph in the written report and not state clearly, this is the value I have placed on this business. This is just a very, very quick summary of what goes into the report. First, you want to have in the report the purpose and the scope of the assignment, the standard of value used. We looked at some of those a minute ago. The identification of the specific interest being valued. Again, is it the 25% interest, common stock interest in a corporation, or is it the entire corporation? You want to have the valuation date clearly specified, and then you can see a couple of other items: scope of the valuation report, the relevant state law governing the entity, and so forth. So the report's going to be very, very lengthy in some cases. You'll have the front pages, almost like a cover sheet, cover letter. They're calling it a transmittal letter. Table of contents. Yes, some of these reports are so long you do need a table of contents. Introduction, company information, financial condition, valuation methodology. There's a lot of information that goes in the report. Almost everything that you have considered, you've looked at, all the work you've done needs to be described in the writing process. Then you'll have some valuation tables maybe later on, some exhibits to include. again, I want to talk about this valuation conclusion. It's always my position that in the very first paragraph, you need to state clearly, based on your estimate, the business is worth blank, so many dollars. That needs to be clear. It needs to be upfront. A lot of time people not read through the entire report. They're just looking for this one number. Show it to them, but still include the full report that really they should be reading if they're interested in this. But always make sure it's very clearly located and identified. Exhibits can include limiting conditions, again if you have those, definitions for various terms you've used, your qualifications and other qualifications of people in your company, your CPA firm, who have placed a value on the business, have worked on this report. Common size balance sheets, income statements, okay, you can include that. Ratio analysis, and that would be good. So it's quite a bit in the report. This is the last slide. So again, this is a quick review on business valuations. We didn't get into the numbers here. That's in your textbook. Again, like I said earlier, very good examples in your textbook. Go back and read those closely. Follow through on all the numbers to see where they come from and find out how professionals can come up with a valuation on a business. All right, so that's it for Chapter 17, and good luck with your studies.